VFE is a Canadian exchange traded fund, and it tracks the S&P 500 index. And so what does that mean? If you're not familiar with some of those terms. So ETF we'll start with, because for me, acronyms are like, hey, what does that mean? What's behind the acronym? An ETF is very similar to a mutual fund. And so you might be familiar with mutual fund, and so that's why I'm going to just kind of branch off and start with that. What is a mutual fund? Um, a mutual fund is where a lot of different people can contribute money into a common fund, and you have a fund manager who picks stocks. And so they might, pick, for example, hey, BlackBerry is doing really well. We're going to invest some money in BlackBerry. We're going to invest some money into, oil. We're going to invest into, consumer products and grocery stores and things like that. And then when BlackBerry is, maybe not doing so well, there's some news about it, struggling, they're going to say, okay, I'm going to take that money out of BlackBerry. We're going to put it into something else. So you have an actively managed fund, and you have a fund manager who's actively managing it and making those decisions. And the benefit with that is that you have somebody watching your finances and making those decisions for you, so that if you're not interested in that stuff, you can go live your life and you have someone who's doing that. The downside with it, though, is that fund managers historically tend to not really be able to outsmart just the market and just what happens. So if you look at data from the entire total stock market and the performance of it compared to what an actively managed, mutual fund in this case, performs at, usually the market outperforms the fund manager. And it could just be that they're making those trades and they're speculating on what's going to go up and what's going to go down. And the truth is nobody knows. And so when you buy the whole market, you just ride the wave. But when you're actively managing it, you're paying fees for those buying and sell transactions. But more importantly, you're paying that person's salary. And that's the really big one. And so that, is one of the reasons why over time, those actively managed funds tend to do worse than if you were to just invest in the entire market and not worry about which ones you're buying, which companies you're in and out of. So that's what a mutual fund is. And so an exchange traded fund, very similar concept, but it has the word exchange traded in front of it. Exchange traded just means that the fund is traded on an exchange, a stock exchange. So you can buy an ETF on, for example, the Toronto Stock Exchange, which is Canada's premier stock exchange. And then in the States, the two big ones are the New York Stock Exchange and then the NASDAQ, which I honestly don't know what that stands for. But that's more tech companies kind of on the West Coast. So ETF might seem like a intimidating acronym, but it's an exchange traded fund, which means that you're able to buy and sell it during market hours on a stock exchange, compared to a mutual fund, which you're usually buying it directly through a bank or an investment firm. So very similar. And then, of course, the really big difference is that mutual funds, for the most part, tend to be actively managed. Of course, there are passively managed mutual funds, though. And then exchange-traded funds, for the most part, tend to be passively managed, which means there's set criteria and the fund is just kind of, for the most part, let's say, automatically determining which stocks are in there, as opposed to a person constantly making those decisions. So that's one part of this. The second part of it is S&P 500 index. What does that mean? So S&P 500 index is just the name that someone or a group of people came up with. It stands for the Standard and Poor 500 index, and it's just essentially a name for criteria that was developed, and it's essentially the largest 500 companies in the United States. And Vanguard is the fund manager. So Vanguard, that's the fund manager. We've got S&P 500 index, which is what are the rules for this fund, basically what's being bought and sold in it. So we know it's looking at the S&P 500 index. And then we can see it's an exchange traded fund. Now down here, we have two other pieces of information. TSE, what does that mean? That's the exchange name, Toronto Stock Exchange, TSE. You'll also see it abbreviated as TSX, and the X just is a fancy way to acronym for exchange. So TSE, TSX, they're both identical. You'll also sometimes see dot .to, just a period and then .to. That is another way to structure it and to say it's on the Toronto Stock Exchange for TO. So there's there's literally three different ways to identify which exchange it's on. So if you see TSE, TSX, or .to, that means it's a Canadian traded stock or exchange traded fund on the Toronto Stock Exchange. And then the last piece of data that we have here is VFE, and that is the ticker symbol. So, you have this big long name here. VFE is essentially the acronym or the short form name for this. So the two critical pieces of information is TSE and VFE. So we need to know the name and which exchange is it on. It's kind of like saying, what's the name of the city and then what country is it in? Because you might have a city like London, London, England, and London, Canada. So you need to know both pieces of information. The reason I say that is because if you look up a ticker symbol, you might be looking for the Canadian symbol, but you might find that it pulls up a US symbol. And the reason is because you've just put in the symbol name and you haven't specified the exchange. So be aware of that. The symbols can be used in both exchanges. That's why both of these pieces of information together is important.